Hello and welcome to Chapter 12 of FIN552, Portfolio Performance. Up to now, we have learned how to build portfolios, how to price risk, and how to choose the best mix of securities. This chapter asks the final, very practical question. Once a manager has run a portfolio for a year, how do we judge whether they actually did a good job? It turns out that the return alone tells you almost nothing, because a high return might simply reflect a high level of risk the manager took, not real skill. So in this chapter, we learn three classic ways to measure performance on a risk-adjusted basis: the Treynor measure, the Sharpe measure, and Jensen's alpha. By the end, you will be able to compute all three for real funds, interpret what each one tells you, and decide which manager truly performed best. As always, every term is defined as it appears. Let us begin with a question. Let me open with the question at the heart of this chapter. Suppose a fund earned 15% last year. That sounds impressive, but was the manager actually good? Or were they simply lucky, taking on a lot of risk that happened to pay off? Return alone cannot answer that, and that is the whole problem this chapter solves. Four ideas shown on the cards lead us to the answer. The first idea: return isn't enough, because a high return may simply reflect a high level of risk the manager accepted, not genuine skill. The remaining three cards are the three classic measures that fix this. The Treynor measure scores reward per unit of market risk that is better, and it suits diversified investors. The Sharpe measure scores reward per unit of total risk, that is the standard deviation. And Jensen's alpha measures the return earned above what the CAPM required, which isolates pure manager skill. These three measures are the spine of the whole chapter. First, let us see who relies on them in the real world. Before the theory, let me show you that risk-adjusted performance measurement is used everywhere money is managed. Look at the first column, Malaysian institutions. The EPF and QAP grade their external fund managers every single year using these measures. ASNB reviews whether its funds beat the FBM KLCI benchmark on a risk-adjusted basis, not just on raw return. And investment committees use Treynor, Sharpe, and Jensen side by side to compare competing managers. In the middle column, ratings agencies and ordinary investors. Morningstar's famous star ratings rest entirely on risk-adjusted performance. Retail investors compare unit trusts using the Sharpe ratio, often without realizing it, and financial advisors justify the fees they charge by showing a positive alpha, evidence that they added value. In the third column, the global managers. Pension funds around the world rank their managers by Jensen's alpha. Hedge funds, as the saying goes, live and die by their Sharpe ratio. And CFA charter holders, the global standard for investment analysts, compute all three measures as a matter of routine. The takeaway ties it together. To judge a manager fairly, you must measure both the return earned and the risk taken to earn it. Let us set out what you will be able to do. Here are our 5 learning outcomes, each tagged with its Bloom's taxonomy level. The first, an understand level outcome, is to explain why a manager's performance must be judged on a risk-adjusted basis rather than on raw return. The second, also understand level, is to describe the two ways a manager can add value: superior market timing and superior security selection. The third, an apply level outcome with real calculation, is to compute and interpret the Treynor measure. The fourth, also apply level, is to compute the Sharpe measure and Jensen's alpha. And the fifth, an analyze level outcome, is to compare several managers using these measures and decide which one performed best. Notice the exam tip: The last three outcomes are calculation-based, so this is a numbers-heavy chapter. You will compute Treynor, Sharpe, and Jensen, and then rank funds. I will walk you through every formula and a full worked example. Let me show you the roadmap. Here is our 5-stop journey through the chapter. Stop 1. Why risk adjusted, where we see why return alone is misleading and why risk must be accounted for. Stop 2. Manager skills, where we learn the two abilities a great manager needs: good market timing and good security selection. Stop 3. The Treynor measure, our first risk-adjusted score, based on beta. Stop 4. The Sharpe measure, based on total risk, the standard deviation. And stop 5. Jensen's alpha, the measure of pure skill above the key APM benchmark. After learning all three, we will apply them together to rank 4 real funds against the market and decide who won. The logic moves from the principle, why we adjust for risk, through the 3 tools, and finally to a complete worked comparison. Let us begin at step 1, the foundations of performance measurement. Welcome to section 1, measuring managed portfolio performance. Before we meet any formula, we need to understand what performance measurement is really about and what we expect of a good manager. The central principle of this whole section is simple but easy to forget. A high return means very little until you ask how much risk was taken to earn it. In this section, we will define performance measurement, set out the 2 core abilities a manager needs, and then look closely at the 2 ways a manager adds value: market timing and security selection. Let us start with the basic idea. Let us define performance measurement properly. As the blue box says, performance measurement asks how well a portfolio did, taking into account both the return it earned and the level of risk the manager accepted in order to earn it. So it is always a two-sided question: return on one side, risk on the other. The 3 cards show the natural sequence. First, the manager forms a portfolio, analyzing the opportunities available and deciding what to invest in. Second, results come in, time passes, and the portfolio produces a return. And now we need a fair way to judge how it actually did. Third, and this is the crucial part, both return and risk count, because a good score reflects the reward earned per unit of risk taken, not just the raw reward. The takeaway is the golden rule of this entire chapter: never judge a manager on return alone, always adjust for the risk taken to achieve it. A manager who earned 15% by taking enormous risk may have done worse, properly measured, than one who earned 10% safely. Now, what exactly do we require of a good manager? So what exactly do we require of a good manager? There are 2 core abilities. The first ability, on the left, is to earn above average returns for a given risk class. In other words, to beat their peers who are taking the same level of risk. That superior return has to come from somewhere, and there are only 2 sources, which we will look at in detail next: better market timing or better security selection. The second ability, on the right, is complete diversification, meaning the manager fully diversifies the portfolio and eliminates all the unsystematic company-specific risk relative to the benchmark. Why does that matter? Because, as we learned in the KPM chapter, on average, the market rewards investors only for bearing systematic market risk, not for company-specific risk that could have been diversified away. A manager who leaves unsystematic risk in the portfolio is taking risk that earns no reward. The blue band at the bottom shows the 2 routes to superior return. The manager delivers either through superior market timing, shifting between asset classes at the right moments, or through superior security selection, buying undervalued and selling overvalued securities. The takeaway: a great manager earns above average risk-adjusted returns through better timing or better selection. Let us look at each of those two skills, starting with timing. The first source of superior return is market timing. As the blue box defines it, market timing is gaining abnormal returns by adjusting the portfolio in anticipation of expected market movements, shifting your money among stocks, money market instruments, and bonds based on the returns you expect from each. The three cards break the skill into steps. First, read the market, anticipating when markets will rise or fall. Second, shift asset classes, moving between stocks, bonds, and cash accordingly. For example, moving into cash before a downturn or into stocks before a rally. Third, the payoff, which is higher returns combined with lower risk. When the timing is right, you capture the upside while sidestepping the downside. The little chart shows the idea: a skilled manager, the gold line, stays above the market through good timing. The takeaway: successful timing means moving into the right asset class before the market does, which gives you both higher return and lower risk. It sounds easy, but timing the market consistently is extremely difficult, which is why it is regarded as a genuine skill. The second source of return is security selection. The second source of superior return is security selection. As the blue box defines it, security selection is building a portfolio that earns abnormal returns by buying undervalued stocks or sectors and selling overvalued ones. Where timing is about asset classes, selection is about picking the right individual securities. The three cards show how it works. First, find undervalued assets, buying stocks or sectors that are trading below their fair value, bargains the rest of the market has overlooked. Second, sell the overvalued exiting stocks or sectors that are priced above their fair value before the market corrects them. Third, an active plus passive mix, meaning a manager does not need to run the entire portfolio actively. They can blend active stock picking with passive index holdings, concentrating their effort where they have an edge. The takeaway: selection skill means consistently buying cheap and selling dear. And importantly, it can be blended with passive holdings. Now we have the principle: judge return against risk, and the two skills, timing and selection. We are ready to meet the three measures that actually put a number on performance in Section 2. Section 2 is the toolkit of the chapter, the three classic performance measures: Treynor, Sharpe, and Jensen. All three share the same goal: to reward high return and penalize risk, but they differ in one key way: how they measure that risk. Treynor and Jensen use beta, systematic risk. Sharpe uses the standard deviation, total risk. We will look at each measure, its formula, what it tells us, and which investor it suits. Once you understand all three, applying them is just arithmetic. Let us start with the overview. Here are the three classic measures at a glance, so you can see the family resemblance before we go into each one. The first, Treynor, measures reward per unit of market risk, that is beta, and it is based on the security market line. It uses systematic risk. The second, Sharpe, measures reward per unit of total risk, that is the standard deviation, and it is based on the capital market line. It uses total risk. The third, Jensen's alpha, is a little different in form. It is the actual return minus the return the KIPM required, which isolates pure manager skill, the value added above the benchmark. So all three share the same philosophy: reward high return and penalize risk, and the takeaway captures the only real difference between them. They differ only in how they measure that risk. Beta for Treynor and Jensen, standard deviation for Sharpe. Let us take them one at a time, beginning with Treynor. Our first measure is the Treynor measure, introduced by Jack Treynor in 1965, sometimes called the reward to volatility ratio. As the blue box notes, it is based on the security market line and it uses beta, systematic risk, as its risk measure, and the rule is simple: the higher the index, the better the performance. The formula in the navy box is the Treynor measure of a portfolio. T sub P equals the portfolio's average return, R sub P minus the risk-free rate, R sub F, all divided by the portfolio's beta, beta sub PP. Let me define the three symbols shown in the cards. R sub P is the average return on the portfolio. R sub F is the risk-free rate, the return on a safe asset like treasury bills. And beta sub P is the portfolio's beta, its systematic or market risk. So the top of the fraction, R sub P minus R sub F, is the excess return, the reward above the safe rate, and we divide it by beta, the market risk, to get reward per unit of market risk. Because it uses only beta, Treynor implicitly assumes the rest of the risk, the unsystematic part, has been diversified away. So the takeaway, Treynor suits investors who already hold a well-diversified portfolio and only care about how this fund performs against market risk. Next, the Sharpe measure, which is almost identical but uses a different risk. Our second measure is the Sharpe measure, introduced by William Sharpe in 1966, the same Sharpe behind the CAPM and the optimization we did last chapter. As the blue box says, it is almost identical to Treynor, with one key difference: the risk measure is the standard deviation of the portfolio rather than its beta. It is based on the capital market line, and again, the higher the index, the better. The formula in the navy box is the Sharpe measure, S sub P, equals the portfolio's average return, R sub P, minus the risk-free rate, R sub F, all divided by the portfolio's standard deviation, sigma sub P. The three symbols in the cards are the same excess return on top, R sub P minus R sub F, but now divided by sigma sub P, the standard deviation, which is total risk, both systematic and unsystematic combined. This is the one important difference from Treynor. Because Sharpe uses total risk, it does not assume the portfolio is fully diversified. It penalizes any risk at all. So the takeaway, Sharpe uses total risk and therefore best suits judging a whole standalone portfolio that may not be perfectly diversified. Let me make the Treynor versus Sharpe distinction crystal clear on the next slide. Students often confuse Treynor and Sharpe, so let us settle it once and for all. The crucial point at the top is that both compute the same thing, excess return divided by risk, and the only difference is which risk they use. Read the 3 points on the left. Sharpe uses the standard deviation, which is total risk, and it is based on the slope of the capital market line. Treynor uses beta, which is systematic risk only, and it is based on the slope of the security market line. So when should you use each? If you are judging a whole standalone portfolio where all of its risk matters, use Sharpe. If the portfolio is just one piece being added to a bigger, already diversified portfolio where only its market risk matters, use Treynor or Jensen. The chart on the right shows the Sharpe idea. Each fund plotted against its total risk sigma with the steepness of the line from the risk-free rate measuring performance. A steeper line is better. The takeaway, Sharpe is excess return per unit of total risk. Treynor is excess return per unit of market risk. Choose the one that matches the investor's situation. Now the third measure, Jensen's alpha, which takes a slightly different angle. Our third measure is Jensen's alpha, introduced by Michael Jensen in 1968. As the blue box says, it measures a manager's skill directly as the excess return of the portfolio over its TAPM required return. The formula in the navy box is alpha sub P equals the portfolio's actual return, R sub P, minus the return the KAPM said it should have earned, which is in the brackets, the risk-free rate, R sub F, plus beta sub P times the market premium, R sub M minus R sub F. So you compute what the CAPM required, given the portfolio's beta, and then ask, did the manager beat that or fall short? The sign of alpha tells the story. A positive alpha on the left means the fund beat its KAPM benchmark, evidence of good investment decisions and real skill. A negative alpha on the right means the fund fell short of what CAPM required, a sign of poor decisions. The manager destroyed value. The takeaway: alpha isolates pure skill. A positive alpha means the manager added value beyond the risk they took, which is exactly what you are paying a fund manager for. Now we have all three tools: Treynor, Sharpe, and Jensen. Let us put them to work on a real example in Section 3. Section 3 is where everything comes together. We have 4 real funds and the market, and we are going to compute all 3 measures, Treynor, Sharpe, and Jensen, for each, and then rank them. This is exactly the kind of question you will face in the exam, so follow the arithmetic carefully. It is all simple division and subtraction once you have the formulas. The most interesting lesson will come at the end. The 3 measures do not always agree on who won, and understanding why is the key insight of the chapter. Let us look at the data. Here is our data. We have 4 funds, A, B, C, and D, plus the market portfolio for comparison. And the risk-free rate is fixed at 4% throughout the example. For each fund, we are given 3 things: its average return, its standard deviation, which is the total risk sigma, and its beta, the systematic risk. Take a moment to read the table. Fund A returned 15% with a standard deviation of 14 and a beta of 1.1. Fund B returned only 8%, but with the highest standard deviation, 20, and the highest beta, 1.4. Fund C returned 13% with a standard deviation of 14 and a low beta of 0.8. Fund D returned the most, 17%, but with a beta of 1.6, the highest, though interestingly the lowest standard deviation, 13. The market returned 12% with a standard deviation of 13 and by definition a beta of 1.0. Look at the notes on the right before we start. Fund D has the highest raw return but also a high beta. Fund B looks like the worst, low return and the highest risk. And Fund C is quietly strong, a decent return earned with a low beta. Keep those first impressions in mind. The takeaway: we will now plug these numbers into all 3 measures, with the risk-free rate fixed at 4%. Let us start with Treynor. Let us compute the Treynor measure for every fund. Remember the formula? The excess return, R sub P minus R sub F, divided by the beta. The risk-free rate is 4%, so first find each fund's excess return, shown in the second column. For A, 15 minus 4 is 11. For B, 8 minus 4 is 4. For C, 13 minus 4 is 9. For D, 17 minus 4 is 13. And for the market, 12 minus 4 is 8. Now divide each by its beta. The sample working in the box shows Fund A, 11 divided by 1.1 equals 10.0. Doing the rest, Fund B is 4 divided by 1.4, which is 2.86. Fund C is 9 divided by 0.8, which is 11.25, the highest. Fund D is 13 divided by 1.6, which is 8.13, and the market is 8 divided by 1, which is 8.0. Look at the bar chart. Fund C in green stands tallest. So by the Treynor measure, Fund C wins with 11.25, the best reward per unit of market risk, because it earned a solid return with a low beta. Fund B is the worst at just 2.86. Notice also that funds C and A beat the market's 8.0, while B and D, by this measure, did not clearly beat it. Now let us see what Sharpe says, using total risk instead of beta. Now the Sharpe measure for every fund. The formula is the same excess return on top, but this time we divide by the standard deviation, the total risk, instead of beta. The excess returns are the same as before, 11, 4, 9, 13 and 8. Now divide each by its standard deviation. The sample working shows Fund D, 13 divided by 13 equal exactly 1.00, the highest. Doing the rest, Fund A is 11 divided by 14, which is 0.79. Fund B is 4 divided by 20, which is just 0.20. Fund C is 9 divided by 14, which is 0.64. And the market is 8 divided by 13, which is 0.62. Look at the bar chart. This time, Fund D in green is tallest. So by the Sharpe measure, Fund D wins with 1.00, the best reward per unit of total risk. Why did D win here when C won on Treynor? Because D has the lowest standard deviation, only 13. So on a total risk basis, it looks excellent, even though its high beta hurt it on Treynor. Fund B is again the worst, at 0.20. Notice the rankings have already started to differ between the two measures, and that is the key lesson coming up. But first, the third measure, Jensen's alpha. Finally, Jensen's alpha for every fund. The formula is the actual return minus the CAPM required return, where the CAPM required return is the risk-free rate plus beta times the market premium. The market premium here is 12 minus 4, which is 8%. So first compute what CAPM required for each fund, the third column. For Fund A, 4 plus 1.1 times 8 equals 4 plus 8.8, which is 12.8. For Fund B, 4 plus 1.4 times 8 equals 4 plus 11.2, which is 15.2. For Fund C, 4 plus 0.8 times 8 equals 4 plus 6.4, which is 10.4. For Fund D, 4 plus 1.6 times 8 equals 4 plus 12.8, which is 16.8. Now alpha is the actual return minus that required return. Fund A, 15 minus 12.8 is plus 2.2. Fund B, 8 minus 15.2 is minus 7.2, a big negative. Fund C, the sample working, 13 minus 10.4 is plus 2.6, the highest. Fund D, 17 minus 16.8 is just plus 0.2. And the market, by definition, has an alpha of 0. Look at the bar chart. Fund C is the tallest positive bar. Fund B is a deep red negative bar. So by Jensen, Fund C has the highest alpha, plus 2.6, the most genuine scale. Fund B destroyed value with minus 7.2. It earned far less than its high risk demanded. Now let us pull all three measures together. Let us pull together what the three measures told us about our funds. The big lesson of this chapter is here. The measures do not all crown the same winner, and that is not a contradiction. It is because each defines risk differently. Look at Fund C, the all-rounder. It came top on both Treynor and Jensen. and was strong on Sharpe too, so it delivered excellent risk-adjusted performance across the board, a genuinely skilled low-beta fund. Look at Fund D, the total risk star. It had the highest Sharpe ratio, a perfect 1.00, thanks to its low total risk, its low standard deviation, but its high beta of 1.6 dragged down its Treynor score, because Treynor judges by market risk. So D looks brilliant on total risk, but only average on market risk. And look at Fund B, the laggard, the worst on all three measures, with a deeply negative alpha of minus 7.2. It took the most risk and delivered the least return, the clearest example of a manager who destroyed value. The takeaway, rankings can differ by measure. Here Treynor and Jensen favor C, while Sharpe favors D. And the reason is simply that each measure defines risk differently, beta versus total risk. Knowing which measure fits the investor's situation is the real skill. Let me give you a one-glance comparison table to revise from. Here is your one-glance revision table comparing the three measures, the slide to photograph before the exam. Read down each column. The risk used, Treynor uses beta, the systematic risk, Sharpe uses the standard deviation, the total risk, and Jensen uses beta as well. What they are based on, Treynor on the security market line, Sharpe on the capital market line, and Jensen on the CAPM equation directly. Who they are best for? Treynor suits diversified investors who only care about market risk. Sharpe suits judging whole standalone portfolios. And Jensen is best for isolating manager skill. How you read them? For Treynor and Sharpe, higher is better. And for Jensen, positive means skill. And their form, Treynor is excess return divided by beta, Sharpe is excess return divided by sigma, and Jensen is actual return minus the KPM required return. The insight at the bottom captures it all. Treynor and Jensen use beta, Sharpe uses total risk. So you choose the measure that fits the investor's situation. If you can reproduce this table and the three formulas, you have the core of the chapter. Let me bring everything together on one page. Here is the whole chapter on a single page, your revision map. At the top, our subject, Chapter 12, Portfolio Performance. Everything flows into three pillars. The first pillar, foundations, the core principle that you judge both return and risk, the two abilities a manager needs, above average returns and complete diversification, and the two sources of skill, timing or selection. The second pillar, the three measures, Treynor, which is excess return divided by beta, Sharpe, which is excess return divided by the standard deviation, and Jensen, which is the actual return minus the CAPM required return. The third pillar, applying them, you rank funds on a risk-adjusted basis. You accept that different measures can disagree because they define risk differently. And you remember that a positive alpha is the clearest sign of real skill. And along the bottom, the single principle that ties it all together, reward a manager for the return earned per unit of risk taken. If you can compute all three measures and explain why they might disagree, you have mastered this chapter. Let me close with a final word. And that brings us to the end of Chapter 12, Portfolio Performance. You now know how to judge a fund manager fairly on a risk-adjusted basis using the three classic measures. Questions are very welcome, so as I like to say, let us measure some managers together. Bring me anything that is unclear. Before you sit the exam, make sure you can do three things listed in the box. First, compute the Treynor measure, the excess return divided by beta. Second, compute the Sharpe measure, the excess return divided by the standard deviation. And third, compute Jensen's alpha, the actual return minus the CAPM required return, and correctly rate each sign, positive for skill, negative for underperformance. Practice the 4 fund worked example until you can reproduce all 3 rankings from scratch, and make sure you can explain why Treynor and Jensen favored Fund C while Sharpe favored Fund D. If you can do all of that, you can evaluate any fund manager the way professionals do, which is a genuinely valuable skill. Thank you so much for your attention throughout this chapter. Take care and happy investing.